Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to discuss why waiting for a Fed pivot is a dangerous trading game. Steve, it's great to see you as always. Welcome back to Trade Talks. And before we get into that sentiment, let's start with your thoughts around non-farm payroll data that we saw this morning.
Good afternoon, Jill. I mean, my feeling is this, if markets have a big reaction to a number that is largely as expected, what were we really expecting? And I see right now labor as being a one-tailed risk. Anything short of a catastrophic labor report is not going to really get the Fed to change. The Fed has a dual mandate. It's stable prices and full employment. We could pretty much check the full employment box for now. And certainly today's number does nothing to uncheck the box. You might actually argue that it pushes us a little beyond full employment, but that's, a statistical quirk in the way the unemployment rate is done. But the bottom line is, I can't imagine anyone hoping for a catastrophe in the labor market. That would be terrible. Otherwise, though, what's the Fed going to do if there's modest declines? The Fed's not going to change, or if the employment picture remains the same, the Fed's not going to change. So, it's what I call the one-tailed risk.
And Steve, you brought up a great point in your note this week that investors who choose to forgo protection or risk management in the hope that the Fed or one of its counterparts will come right into the rescue, that you're playing a dangerous game. And Steve, I feel like everyone who's in the investing game knows, don't fight the Fed, right? I mean, we've been saying this for decades now, and it still seems to be that people are surprised when you see data like this comes out, or they're hoping that the Fed is going to make a pivot here.
Don't fight the Fed was a great mantra. It's always been a great mantra. The difference, though, is the Fed was your friend for the better part of 14 years or so. And so, we forget that sometimes the Fed taketh away after giving for so long. And so, if you like the logic on the way up, you have to respect it on the way down. And the Fed is raising rates, and they're reducing the size of their balance sheet, both of which are a drag on risk assets or anything that involves money. Basically, the Fed balance sheet has been shrinking as the Fed implements the faster QT, and we're seeing that in some numbers as well. I tweeted out a chart of that today, and so you can't fight them. And I think it's kind of a folly to sort of just sit there and hope that they're going to change their mind when Chair Powell and pretty much every one of his colleagues comes out and says, we're going to keep raising rates, and we're going to keep the balance sheet reduction going until or unless things change. And it's certainly on the labor point, as we just alluded to, it's not changing. Let's see what happens. We get CPI and PPI next week. We get the PCE deflator on the 27th, which is the bigger number for the Fed. But until then, I can't see any change in Fed rhetoric, let alone Fed action. And as a result, that's where you sort of have to protect yourself, and that's where we have to be respectful of selling the rips, which is literally what we saw this week. Was we bought the dip, we were oversold. That's good, but we also got overextended very quickly. That's the sell the rips, and that's where protection comes in handy. And the time to buy protection is when you don't need it. It's much cheaper to buy an umbrella when the sun is shining than buying it from one of those guys on the street when it's raining.
Yep. And that's such a great point that you make about respecting their strategy on the way up and the way down, because even when there was a slew of liquidity in the market, they were very clear about, supporting the balance sheet and the economy and so forth. And they're saying it just the opposite way right now, that we're dialing back and we're raising rates. And it seems to be, it's always a surprise when they haven't changed their messaging, just like they didn't when they were flushing the system with liquidity. Let's move away from the Fed for a moment. We're finally getting into earnings. I think investors and traders are looking forward to something else to speak about besides macro. What are your thoughts going into the earnings season?
This is going to be a tricky one. And this goes back to your protection comment. The time to start thinking about protection around earnings season is now. It might not always be the optimal time to do it, but what we're seeing from a wide range of companies are disappointments to a varying level. We saw it with Nike, we saw it with CarMax, we see it with AMD. There's been a lot of high-profile misses or high-profile shading of guidance in a negative way. What we don't know is how the markets will react to that. I think one of the keys is, in January and April, we saw the markets really react negatively to disappointment. In July, not so much. I can't yet predict how we're going to react in October, but that's why you need to start thinking about which companies you have that might be exposed on an earnings basis, and start thinking about where appropriate hedges are. It's cheaper in implied volatility terms to buy protection a little early. It's more expensive in terms of time premium, of course. So there is a bit of a balancing act. I put out something earlier this week on our website explaining that dynamic. Right now, the early returns from earnings season are not great. And as a result, I think we have to be cautious. But if the market can sort of weather the storm, well, that's encouraging. But it's too early to say.
And Steve, I want to wrap up with some strategy here for a moment. And you had also mentioned in your note about the risky allure of short-dated options. Explain to us what that risk is all about.
Sure. I was contacted by some Wall Street Journal reporters who were writing about how so much of the volume in the options market has gravitated to options expiring in a week or less. It's about 50% right now. And there are real pros and cons to trading very short-term options. The pro, of course, is you're paying essentially very little in time premium. The con, of course, is, number one, that time premium falls off a cliff. One of the first lessons I was taught as an option trader was time premium falls off a cliff in the last week. And basically, so you're only buying things, even though the time premium or theta, which is decay, is low, it will move away from you very quickly. That can also benefit writers, by the way. If you're writing covered calls, you can capture that more quickly than you might if you wrote a longer term call. But the problem is these trades resolve themselves very, very quickly. The risk reward is enormous. What it means either way is you can make or lose money very quickly, but also remembering that since most options tend to expire out of the money, be very careful with what you're doing here. Don't if you're doing this because of really risk valid trading reasons or establishing a position that you have some confidence in, go ahead. If you're treating this as gambling, be very careful, because that's not what we want to see, and it's ultimately not a winning strategy for most people.
Yep. Great advice as always, Steve. Appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.